The S&P 500 is down almost 8% from the beginning of 2022, and the Nasdaq Composite Index, consisting of tech giants like Apple, Google, Microsoft, Facebook, and Tesla, is down a whopping 11% in just the past 14 trading days. And while all of us had immense hope in the stock market to help us achieve financial independence by going to the moon one day, significant drops like what we just experienced in the past 3 weeks are nothing short of scary and devastating. So, is the dip that has already dipped beyond our thinking going to dip even further? Are we at the brink of an economic recession that will have lasting impacts on the pockets of majority of Americans? And if we are about to enter a recessionary period, keep watching until the very end to understand what are some things that you can do starting right now that will help you calmly put tough days behind you while keeping an eye on the bigger picture. Hey, my name is Shuril, and on this channel we talk about all things money that they don't teach you in school. First things first, let's try and understand why there is so much fear and subsequent dumping of securities in the market that is making you wonder if you did the right thing by parking thousands of dollars in crypto in 2021 in hopes of printing tendies one day. Back in 2020 and 2021, when the pandemic was still active and resulted in millions of people losing their jobs, causing massive supply chain interruptions, and creating a frenzy among consumers to stock up on the most important things in life, including toilet paper, the Federal Reserve started printing billions of dollars out of thin air every single month to give a boost to a slowing economy and help reduce interest rates down to almost zero. This gave a massive boost to borrowing for people like you and I to purchase cars, homes, and other expensive items that we normally couldn't purchase during prior times due to higher interest rates. But towards the end of 2021, this whole idea of stimulating the economy with newly printed money started seeming like it went a little bit overboard when every single asset class in the country started feeling like it was a bit overinflated, including homes that went up by 20% from just a year before, used cars that went up more than 30% from just a year prior, and the stock market having more than doubled since its drop at the beginning of the pandemic in April of 2020. This massive inflation in asset prices as well as day-to-day commodities gave rise to another sizable monster that no one ever thought would be as big of a problem as it eventually turned out to be: inflation. Inflation in the United States typically runs around 2 to 2.5% every single year. Can you guess what the inflation number for this past year was? Inflation rose by a colossal 7% for 2021. Just to give you a better perspective, the Federal Reserve has an inflation target of 2 to 2.5% every single year. 2% inflation is considered healthy as it keeps the economy running as well as growing smoothly every single year. 7% inflation can be catastrophic. This would mean that if you had set aside $100 for purchasing Christmas gifts for your nieces and nephews on January 1, 2021, that $100 would only be able to purchase $93 worth of presents by Christmas time that same year. Basically, inflation is like a baby monster that slowly keeps munching away on your hard-earned money every single year unless you make sure to grow that money somehow and get higher returns than what inflation is worth for that particular year. Inflation also means higher prices for most stuff to purchase out there and leads to lesser affordability for American families as their income and savings fail to keep up with rising inflation every single year. To combat higher inflation and wild economic conditions, the Feds intervened in December of 2021 and decided to take some serious measures. For starters, the Feds decided to slow down economic stimulation relatively quickly and start raising interest rates as early as March of 2022. Feds also hinted at raising interest rates 3 times throughout 2022. This news seemingly did not affect the stock market to the slightest, as some of this activity was kind of expected and was priced in by December last year. However, just a few weeks ago, the Fed released meeting minutes from their meeting in December that provided more clarity on their direction to reduce inflation over the next year, and all hell broke loose. What started creating panic in the stock market was not just the idea of increasing interest rates, but possibly increasing them several times throughout 2022. When interest rates rise, borrowing money becomes more expensive, putting more strain on people's finances and restraining people's freedom to go out and spend money, either via larger purchases such as mortgage and cars, or smaller high-interest purchases made through already expensive credit cards. In times of interest rate increases, it is expected that people will spend less money as it gets more expensive to do so, and therefore the economy will be relatively less stimulated, in turn affecting revenue for publicly traded companies such as Apple and General Motors. As revenue drops, profit drops, and this affects the price of the stock for such companies. And since the stock market prices itself on future profits, the bloodbath we are seeing now is basically nothing but an indication of upcoming pain in the economy. But this exercise is not new, and interest rates have gone down as well as gone up in previous years too. Just in 2018, the Fed raised interest rates before lowering them again in 2020 and created a minor panic in the stock market. So why is it now that everyone is more fearful of rising rates and a possible economic recession? Well, one of the other devastating things that was disclosed when the Fed meeting minutes were released was that not only will the Federal Reserve completely stop stimulating the economy by March of this year, but the Feds will also slowly start reducing its balance sheet to get a better grip on the economy and inflation that has in recent times run completely amok. The Federal Reserve purchases treasury bonds from the government to inject more money into the economy, and it has done just that, first from 2008 up until 2014 to stimulate the economy after the 2008 financial crisis, and then again starting 2020 until March 2022 to stimulate the economy from the shocking effects of the pandemic. This has given rise to a massive $9 trillion balance sheet consisting of several government bonds that the Federal Reserve maintains. This time around though, the Federal Reserve has decided to reduce its $9 trillion balance sheet and giving rise to a liquidity shortage in the market. In simple words, the Federal Reserve injected $9 trillion to help stimulate the economy over the past few years, and now they are talking about taking some of that money back, leading to lesser money in circulation for you and I to borrow, consequently making borrowing even more expensive than it was before. And because of this dreadful strategy from the Federal Reserve, every asset class in the country is currently suffering a valuation loss as institutions as well as retail investors prepare for an upcoming shortage of free cash circulating the market, resulting in even further reduction in revenues as well as profits for publicly traded companies and potential further decline in the stock market. Given everything out of the norm that is going on in the economy right now, I would not be surprised if we see a recessionary period that would start somewhere around the end of this year. This may potentially involve job losses, income declines, and on a more brighter side, may reduce prices for goods in the market, thus reducing inflation down to the Federal Reserve target of 2%. Once again, I don't mean to scare anybody out there, and all I'm trying to do is prepare you for what could be the worst economic climate we may have seen in the past few years. That is why it is important to understand, first of all, what factors can lead to inflation, which we just looked at, and what are some things you should do to navigate these rough waters like a seasoned recession veteran. Number one thing to do is to save more cash on hand. Now, this may seem like a simple thing to do, and you might be wondering, how in the heck can this help you beat recession? Let me tell you how. If you were to be caught up in a situation where either you are living paycheck to paycheck or you invested all your saved money into cryptocurrencies at their high back in November 2021, chances are that you have no money on hand and are living paycheck to paycheck every single month. It would be catastrophic to lose your job in such a situation, as number one, you would have no cash coming to you each week to pay for essentials, while simultaneously, if the market is down, your investments could be down say 30 to 40%, making liquidating those investments and using them for essentials even harder. In such situations, it is crucial to have at least about 6 months worth of expenses saved up in cash so you can easily navigate tough economic periods without selling investments at a loss and without having to choose between paying for rent or paying for insurance for that particular month. The second thing to do is to find buying opportunities and act on them. Yep, while it's essential to save cash, it is also extremely important to buy the dip. Recessionary periods present exceptional buying opportunities for growth stocks or even the market indices, as you can scoop up some of these at massive discounts and then just let them rise for the rest of your lives. At the same time, having a relatively decent position in cash is also important during recessions, so make sure you are only taking calculated risks when buying the dip and not dumping all your emergency savings into securities that could potentially drop further in the short term. And third, and the final thing to do is to stay calm and stay the course. Guys, if we do end up in a recessionary period, this probably won't be the first time the US economy would face rough waters like we may be about to. Data suggests that US has been through recessionary periods 48 times in the past 300 years, and if you were to invest in the S&P 500 at its onset in 1926 and not panic sell during the 1930s Great Depression, 1945's World War, the 1980s economic recession when Feds raised interest rates extremely fast to reduce inflation, the 2001 dot-com crash, the 2008 financial crisis, and most recently the 2020 pandemic crash, you would still be sitting with an average return of 10.5% every single year from the market index. Meaning, if you were to invest $100 in the S&P 500 in 1926, today that money would have grown to $2.3 million without you touching it or even adding a single dime to it. This emphasizes the importance of staying the course and not panic selling if you already have money invested in the market, and spending recessionary periods with a more moderate lifestyle, giving a higher importance to savings than you normally would. Thanks so much for watching, guys. I really appreciate it. Please don't forget to like this video below and subscribe to my channel for more personal finance videos. Also, if you are tired of just watching me in this small frame, please follow me on Instagram as well as on TikTok, where I share spicy insights of my personal life and how I save money pretty much on a daily basis. Alright everyone, see you again soon. Thanks so much for tuning into my channel.